Imagine waking up to a world where your retirement nest egg isn't limited to stocks and bonds, but includes Bitcoin, Ethereum, maybe even private real estate. Picture the opportunity, the risk, the audacity of it all. Today, that possibility is closer than ever, and you'll want to stick around to grasp every twist. Here's where we start. On August 7, 2025, President Trump signed a landmark executive order aimed squarely at expanding retirement portfolios to include alternative assets, cryptocurrencies, private equity, real estate, all those buzzworthy, high-octane investments. This order directs the Department of Labor to revisit ERISA fiduciary rules, while the SEC and Treasury are tapped to pave the way legally for these changes. That's not just big, it's seismic. Think about the sheer scale 401k plans hold. Around $9 trillion in assets managed by roughly 90 million American savers. If crypto and private equity options start lining these portfolios, the gates could open wide for trillions in new inflows. Big private equity players, Blackstone, Apollo, KKR, have already struck deals anticipating just this momentum. But let's ground ourselves. While this may democratize access to high-return windows, critics sound alarms. These assets carry higher fees, less liquidity, and unpredictable volatility, all things retirement planners typically avoid. And despite the Biden-era warning that urged extreme care in offering crypto in retirement plans, Trump's Labor Department revoked that guidance in May 2025, pivoting to a neutral stance, neither endorsing nor disapproving crypto in 401ks. That setup alone is enough to get anyone's heart racing, but there's more. Let's shift to Bitcoin. As the day unfolded, markets roared. BTC surged to over 116,500. That jump followed closely after headlines broke about the executive order, signaling fresh bullish sentiment. By the time CoinDesk published the Crypto Daybook Americas briefing, Bitcoin had pushed past $116,400, buoyed by weakening job data and renewed bets on a Fed rate cut in September. Every layer here matters. Not only did Trump's policy action ignite a rally, spiking demand, macro tailwinds piled on, reinforcing confidence in continued BTC upside. Now, Ethereum is stealing its own spotlight. Transaction volumes on the Ethereum network just hit a one-year high as U.S. regulators released guidance easing concerns around liquid staking protocols. More than 36 million ETHs, nearly 30% of total supply, is currently staked via smart contracts, reflecting a huge amount of capital being locked for rewards and longer-term play. Here's the kicker. The SEC's Division of Corporation Finance explicitly said staking receipt tokens may not qualify as securities under the 1933 Securities Act, sending a major optimistic signal to DeFi builders and institutional investors. DeFi developers hailed it as a turning point. Institutions can now confidently integrate liquid staking tokens into their products, said Alluvial CEO Mara Schmidt. But it's not a unanimous opinion. Commissioner Caroline Crenshaw cautioned that the position relies on assumptions that may not hold up under scrutiny. And while that regulatory windfall brews, remember, the SEC is still dragging its feet on approving Ethereum ETF staking and broader decentralized finance regulation, like the U.S. Clarity Act or EU's DeFi provisions, are still works in progress. So let's zoom out and blend these threads. Trump's executive order isn't a small tweak. It's a signal. It broadcasts that crypto and alternative investments are no longer fringe. They're entering mainstream retirement frameworks. That moves the game from speculative whispers to portfolio-level possibilities. At the same time, Bitcoin's rally above $116,000 underscores renewed institutional appetite, driven by policy moves, macro forecasts, and perhaps a sense that digital assets are finally treated like traditional hedges. Ethereum's rise in network activity suggests that users and institutions are doubling down, staking big even amid regulatory gray areas, making it clear that the network is being used, not just held. That tells us something powerful. It's no longer talk about future potential. Usage is the narrative. But every layer here carries risk. Portfolio managers still wrestle with legal liability, volatility, and whether plan participants truly understand what they're buying. Critics warn of lawsuits if plan sponsors get reckless, and while regulators have offered signals, explicit guardrails are still being negotiated and drafted. Now, this is where you come in, where your voice counts. What do you think about crypto in your 401k? Is it the ultimate diversification move or a reckless gamble that retirement account managers shouldn't touch? And with Bitcoin's recent surge, do you believe this momentum will hold, or is it just short-term FOMO amplified by headlines? On Ethereum, seeing so much ETH locked and such activity, it looks bullish. But does regulatory uncertainty undercut that optimism? Take a moment. Weigh in with your thoughts. I want to hear whether you're embracing diversification or doubling down on caution. Did this breakdown help untangle the day's drama? If so, hit like, subscribe, and ring that bell, because the next big crypto shift might just be around the corner.